AI has moved into its industrial phase. Training and running these models now requires massive, heat-generating operations that draw immense power. The market has already priced in much of this build-out. This consensus has pushed valuations for primary chip makers like NVIDIA to historic highs, leaving them vulnerable to any shift in sentiment. Investors holding a portfolio purely concentrated in those top-tier chip makers are carrying significant volatility risk. They are fully exposed to the impact of a potential near-term correction. We are analyzing how two elite institutional investors are navigating these high valuations using two completely different frameworks. Profit in the current hardware cycle is moving away from the most expensive stocks and toward the companies solving physical bottlenecks in the supply chain. Our case studies are Leopold Aschenbrenner of Situational Awareness LP and Gavin Baker of Atreides Management LP. We track their moves through 13F and 13G filings submitted to the Securities and Exchange Commission, which require major funds to disclose their U.S. holdings. These filings are delayed. A 13F is only due 45 days after the quarter ends, meaning the data we see in mid-May actually reflects decisions made months earlier. However, Leopold's May 27th 13G filing provides a fresher signal. This specific document is triggered when an investor crosses 5% ownership, offering a more immediate look at a major move. Gavin's Q1 13F provides a broader perspective on how he is accumulating assets across the ecosystem, even if the data is slightly older. Our goal is to understand the frameworks these managers use to navigate the AI cycle, rather than attempting to copy-paste their specific tickers. Leopold uses heavy options trading to manage his risk. He has layered significant put options across the semiconductor complex, targeting both individual stocks and sector-wide ETFs. This strategy provides a floor against a tech crash, but it carries a cost. Those put premiums act as a constant drag on returns if the market remains stable. While he hedges the chips, he is concentrating capital elsewhere. His 13G filing revealed a 5.6% stake in Nebius, representing a $2.6 billion bet on cloud and data center capacity. This high-conviction trade offers massive potential returns if Nebius captures its market, but introduces heavy single-company risk if management fails. He has also added Bitcoin miners like CleanSpark and Riot platforms, targeting companies that already possess high-density server infrastructure. These miners are increasingly pivoting to high-performance computing. They control the existing power contracts and cooling systems that are becoming the next major bottleneck for AI. Leopold is running a tactical playbook, capping his downside on expensive chips while swinging heavy at the specific physical constraints of the build-out. Gavin Baker takes a more traditional approach. He avoids single stock puts entirely, maintaining a straightforward, equity-focused long book. He is focused on networking and optical enablers, holding positions in companies like Atreides and Ciena. This strategy targets the secondary wave of spending. Once the server clusters are built, moving data between those racks efficiently is the next technical hurdle the industry must solve. These derivative plays depend on the primary hardware build-out continuing at pace. They generally offer lower volatility than pure chip makers, but also lack their explosive upside. For downside protection, Gavin uses broad QQQ index puts. He is hedging against a total market collapse rather than trying to time a specific sector correction. Gavin's strategy is a steady, long-term bet on the entire physical supply chain, protected by broad market hedges. Comparing these philosophies, on risk, Leopold uses targeted stock puts. Gavin relies on broad index hedges. For compute, Leopold holds one massive cloud stake. Gavin holds a broad chip basket. In infrastructure, Leopold buys raw power. Gavin buys data flow. Active risk mitigation and broad ecosystem exposure represent two distinct ways to manage the same market conditions. Despite their different risk profiles, both managers have identified the same core reality of the AI trade. Capital is rapidly rotating away from pure logic chips and into the massive physical constraints of the real world. The current bottlenecks are power delivery, the massive cooling systems required to manage heat, and raw data center square footage. AI software cannot reach its full potential until these real-world infrastructure constraints are resolved. Power generation and high-speed data movement have become the critical utilities of the current economy. Applying these frameworks requires understanding your risk profile. Leopold's approach is for active investors managing daily options. Gavin's strategy suits long-term portfolios, riding out drawdowns. For most, the safest path is a watch list of shared themes: power, data centers, and optics. Watch for hyperscaler power announcements, new site selections for data centers, and high-speed networking hardware deployment. Institutional filings reveal where capital was yesterday. The next generation of returns depends on identifying the physical bottlenecks forming today.